Hi guys. So yesterday we saw financial management exam being conducted for the first time in almost 1.5 years. Right? Some of you may have seen the question paper, and I believe it was very easy. Right? With the knowledge that you already have, with a little bit of luck, you might be able to get through even yesterday's paper if you had done it. But I hope none of you have done it, and this is the first time all of you are doing this exam. Because if you have done it, then I don't want to see any of you in this class today. And so this paper is very easy. You can get through with your eyes closed, but the examiner loves to test the basic understanding, which is the right thing to do. So all you need to have is a basic knowledge. The rest is going to be very easy. If you understand the basics, that can get you through. Right? So it's such an easy subject. Right. So let's hope that everyone had done yesterday's paper very well. Right. So let's move on. We were on to business valuation last week. We did absolute valuation methods using discounted cash flows. Remember, 1 period dividend discount models, 2 period. Then we used Gordon's growth model. And today we'll get to relative valuation methods. Right. So any questions from last week? Okay, so if there are no questions, let us move on. Just to quickly recap, let's do the Gordon's model question once again. Right. Apple recently paid a dividend of 1.8. An analyst has estimated the financial has examined the financial statements and historical dividend policy of Apple, and expects that the firm's dividend rate will grow at a constant rate of 3.5% indefinitely. The analyst also determines that the required rate of return on investment is 10%. You asked to calculate the current value of Apple shares. So let's use Gordon's model. So the recent dividend growth rate of 3.5%. Return on investment is 10%. we will end up with the share price of 29.34. Dinesh, these formulas might be given at the exam, but it's always safe to remember them. Right? These are standard. It's good if you remember these. Not very difficult formulas to memorize, so might as well remember them. Now, the dividend discount formula, the 1 period, 2 period dividend discount formulas, there is nothing new to learn. Right? Because it's very simple cash flow discounting. By the way, I hope you can see the board today. Can you all see the board? Cool. Right. So, any questions from absolute valuation? No questions. Let's move on to relative. Multiplier models. Price multiple refers to a ratio that compares the share price with some sort of monetary value to allow evaluation of the relative worth of an asset. Value of a stock based on the average price multiple of stock of similar companies, right? So what you do is you take a benchmark in the industry. Now, for example, if you're a bank, you can take a benchmark. Maybe you take the bank in the country with the highest market share, right? Something like that. That can be the benchmark. Or you can take an industry average. Right? It's up to you. There is nothing cast in stone that you should pick this particular benchmark, but maybe an industry average is good. Right? So you can pick a certain ratio. Now, let's say, for example, just throwing out examples, the NPA ratio of your benchmark is 5%, right? And you are going at 4%. If you are going at 4% there, the benchmark is 5, that means you are doing better. Then you can drill down further and see how are you doing better, what are you doing better than the other banks. But if you are at 7%, that means you're not as efficient as the market. Right? So you can pull up your socks, you can do much better than this. That's what you do. You compare with the industry. That's why it becomes relative. So likewise, you can compare prices also. Right? Now, for example, if you compare prices directly, right? The price of Sampath Bank, share price of Sampath Bank 200 rupees, whereas the share price of Commercial Bank is 105. Right? So looking at those two share prices, Commercial Bank and Sampath Bank, it is difficult to say that Sampath is better than Commercial. Why? Because it's not really the share price that matters. You need to look at the ratio. You can't look at the price alone and decide. That's why you use price multiples. And so let's see what the multiples are. It gives the values of a stock based on the average price multiple of stocks of similar companies. One multiple you can use is the PE ratio, the price per share divided by earnings per share. This is one ratio you can look at. Price divided by earnings per share. So let's try this example. MK Technologies shares are selling for $50. They were bought for $40. Earnings for the last 12 months were $2 per share. You have to calculate PE. Now this ratio, price divided by earnings per share, right? It gives an indication of how long it will take for the company to recover its investment. And now, for example, if you buy Sampath Bank shares at 200 rupees and the earnings per share of Sampath Bank is 20 rupees per share, that means every year you earn 20 rupees on your investment. Like your investment gives you a return of 20%. Which also means it takes you 10 years to recover the investment, right? You have invested 200 rupees, every year you get a return of 20, or it gives a return of 20, so it takes 10 years for you to recover the investment. Then if you take the other way around, earnings per share divided by price, right? The inverse, it gives you an idea of how much of profits this particular investment generates for every rupee that you invest. Every rupee that is invested, what profit does it generate? Right. So going back to the question, MK Technology shares are selling at $50 per share. The price is 50. They were bought for $40. Earnings for the last 12 months, $2 per share. Earnings per share is 2. Price is 50. You are asked to calculate the PE multiple. Right. So very simple. PE ratio is the price of 50 divided by earnings per share of 2. PE multiple is 25. Right, so NK Technologies has a PE multiple of 25. Now, if you're looking at this alone, then you won't get an idea. But if you look at, compare it with the industry, if the industry is going at 50 and MK is doing 25, that means if you assume that MK is as good as the industry, then MK is undervalued. Why? Because the industry is going at 25. Sorry, industry is going at 50. MK is 25, right? And if MK is as good as the industry, that means the profits that they generate are in line with industry standards, right? So the earnings per share they give should be in line. They are good as efficient as the industry. Now, if you look at this equation, earnings per share is the last 12 months earnings divided by the number of shares. So last 12 months earnings will not change. Number of shares will also not change. Those two are fixed. Meaning the only thing that can change is the price, right? For this to increase from 25 to 50, the only thing that can change is the price. That means the only thing that can change will be the price, which has to go up. And so therefore it is undervalued. Your recommendation will be to buy. But if the industry is 10, MK is 25, that means there is something wrong. And if MK is not doing anything extraordinary compared to the industry, maybe it is a little overvalued. Then you will issue a sell recommendation. So that's how these recommendations are issued. You compare with a benchmark. Okay, so any questions on that? PE models, there are two types of PEs. One is called the trailing. That means the last 12 months. Other one is the leading, the next 12 months. Trailing PE is the market price of a share, right? Remember, it's always the price of a share divided by earnings per share. If it's trailing, you look at the last 12 months earnings per share. Right? In each case, the numerator is the same, always market price per share. Denominator will change. If it's trailing PE, that means the last 12 months earnings per share. Leading PE means the forecasted 12 months earnings per share. Right. So let's try this question. Biden Investments reported 32 million earnings during fiscal year 2007. And analyst forecast and earnings per share for the next 12 months of €1. It has 40 million shares outstanding at a market price of 18 per share. You have to calculate Biden's trailing and leading PE ratios. Right, so let's give it a try. So let's calculate trailing. And we start with price. By trailing. So the price of a share. It reported 32 million earnings during 2007. That means last year they reported 32 million. Earnings per share over the next 12 months, which is the leading. Next 12 months is leading. Last 12 months is trailing. Leading earnings per share is 1. 40 million shares outstanding. Market price of a share is 18. So price of a share is 18. Trailing PE. Trailing earnings per share. Last year 32 million. Number of shares 40. So you get 18 over 0.8. You get a trailing PE of 22.5. Then leading PE is the price per share divided by forecast EPS is 1. Price of a share is 18 divided by the forecast earnings per share is 1. So the leading PE earnings per share is 1, meaning you get 18. Leading PE is 18. Okay, so any questions on this? Any questions? So estimating intrinsic value of a share in relation to comparable PE ratios. Right? Now, if you go back to this equation, PE ratio is the price divided by earnings per share. Right? So the price, in other words, is equal to the PE ratio into earnings per share. So that is what is given here. It says the intrinsic value is equal to industry PE into earnings per share. So this is what you need to know. Right. So let's try this question. MK Technologies shares are selling for $50, right? Price is $50. Earnings for the last 12 months, $2 per share. Average trailing PE for the firm's industry is 32 times. You asked to calculate intrinsic value of a share and decide whether it is undervalued, overvalued, or fairly valued. Okay, so let's use the same equation. So MK Technologies selling for $50. Comparable earnings for the last 12 months for $2 per share. Average PE ratio in the industry is 32 times. Just to calculate intrinsic value of share and decide whether it's undervalued, overvalued, or fairly valued. What do you all think? What do you think? Undervalued. Okay. So the share price is $50. Earnings for the last 12 months, $2 per share. The average trailing PE in the industry is 32 times. Meaning the intrinsic value should technically be $64. Whereas now it is going at $50 a share. Okay. Intrinsic value is 64, but the share price is $50. So you are right, it is undervalued. Okay, guys, so what you need to say is MK Technologies is trading at $50 per share, whereas the intrinsic value is $64. Therefore, it is undervalued. Right, so any questions on that? Excellent. Let's move on. Next question. Consumer products has a trailing PE of 27.52, while the median peer group PE is 33.25, assuming that there are no differences in fundamentals among the peer firms and consumer products. Firm is correctly valued, overvalued, or undervalued. What do you think? Undervalued. Is it? Consumer products has a trailing PE of 27.52. consumer products. And the peers. Peer group 33.25. And so peers are the industry. Assuming there are no differences in fundamentals among the peer firms and consumer products, the firm is correctly valued, overvalued, or undervalued. All right. So trailing PE is price divided by earnings per share. Now, earnings per share, since it's trailing, that means the last 12 months, earnings per share in the last 12 months will not change because accounts have been finalized and closed. Last 12 months figures will not change. You can't touch last 12 months. Right. Now, consumer products is 27.5. Industry 33.25, which means the industry is better. Has a better EPS. PE, sorry. Has a better PE ratio. And it says there are no differences in fundamentals between peer firms and consumer products, right? So fundamentally, they are the same. There is nothing very special about the industry. Consumer product is just as good. If that is the case, the PE ratio should be in line with the industry, right? Which means it is now 27.52 and it has to increase to 33.25. So it has to go up. This needs to go up to this level, 33.25. Okay. Now, EPS will not change because it is trailing. Last 12 months, earnings per share, you will not restate normally. So earnings per share, no change. No change. So only variable that can increase for this ratio to go up is the price. The price will have to go up. That is the only way out. Price will have to increase. Meaning it is currently undervalued. So you were right, it is undervalued. Okay, so consumer products is undervalued. Is that clear? Right. So let's move on. Then we move on to asset-based models. Right. These are used estimates of market values of assets and liabilities in arriving at the value of a share. it's relevant for companies that do not have high proportions of intangible assets. Okay, so you take the actual value of assets and liabilities. How much are they actually worth? And then you divide by the number of shares, you should get the value of a share, the price of a share. It's called an asset-based model. So let's try this example. So once again, iPhone has 1,000 shares outstanding. Market value of inventory and accounts receivable. Inventory currently is at 30,000. Accounts receivable at 15,000. As reported, the market value of net fixed assets, which is at 70%, is 120% of reported book value. Right, so actual market value, the book value is 70,000. It has to be 120% of what is reported, meaning it has to be 20% more than this, which is 84,000. Using asset-based valuation approach, estimate value per share from adjusted book value. Okay, so value per share is 254. Let's see. Now the book value of cash is 5,000. It will not change. It will not change. Why? Because cash 5,000, the book value is 5,000, means you have physical 5,000 rupees or $5,000 or whatever. It will not change. The only thing that can change is, let's see. So let's put the assets. Mark the book value and the market value. Cash 5,000 book value, market value also remains 5,000. Accounts receivable. $15,000. Inventory is 13,000. 30,000. Net fixed assets 70,000. Total assets. $120,000. Then the liabilities. Accounts payable. $20,000. Term loan 25,000. Equity 75,000. So it's 120,000 again. Market value of inventory and accounts receivable. Inventory and accounts receivable are as reported. Actually, this remains at 15,000. Inventory remains at 30,000. Market value of net fixed assets is 120% of book value. Book value is 70,000, so net fixed assets should be 20% more, which comes to 84,000. So your total assets will be 134,000. Then it doesn't mention anything about the market value of accounts payable and term loans being different. So let's put them down as it is. 20,000 accounts payable, term loan of 25,000. Now for the balance sheet to tally, the only variable that can change is equity, right? It's now 75,000. It has to increase by 14,000, isn't it? So you have to apply 89,000. $134,000. So now the total value of equity is 89,000. iPhone Limited has 1,000 shares outstanding. The value therefore is 89,000. Value per share. The value share is 89,000. That's total equity divided by number of shares, 1,000. Should be 89. Right. Because it's 89,000. The value of 89,000 comes from 1,000 shares. 1,000 shares worth 89,000. Equity in this case is worth 89,000. So the share price should be 89. Is that clear? How I got the equity value? Well, if you take the balance sheet, total assets should be equal to total liabilities, isn't it? Unless there's something seriously wrong, fundamental principle, right? Total assets equals total liabilities. Now it says that net fixed assets is worth 20% more than the book value, right? Net fixed assets is worth 20% more than the book value. So book value of net fixed assets 70,000, but it's actually worth 84,000. So the asset side is going up by 14,000, ending up with 134,000 total. Then accounts payable and term loans will not change. The only variable that can change is the equity. Okay, equity is currently valued at 75,000. and it has to increase by 14,000 so that the total asset of 134,000 is in balance with the total liability base of 134,000. You end up with you need to end up with a liability base of 134,000. It is your total asset base. Okay, so equity in total is worth 89,000. You have 1,000 shares. Therefore, you end up with a share price of 89. Is that clear? Maureen, how did you get 254? Yeah, okay. Right. So let's not confuse ourselves. Right. Dinesh, I hope everything is clear. Dinesh?
Yes, sir.
Okay.
It's clear.
Right. So let's move on. Equity valuation. Now, the value of equity depends on so many factors. What we just studied are absolute valuations and relative valuation. Now, on top of that, the absolute valuation, relative valuation, everything depends on so many other factors. Numerous factors will impact or affect the value of equity. Can be international factors. Like look at Corona. It's something that happened in China. Right, had a serious impact on share prices. Right, initially we saw the share market dropping, and then it recovered. Fiscal policy, meaning the policy on taxes. Right, now, there was so many tax incentives given for investing in equity. The fiscal policy. Monetary policy, interest rates being brought down has affected the stock market. Right. Economic conditions, economic recovery post-corona is helping the stock market boom. Industry conditions, the focus on local industries post-budget. Firm-specific conditions. Now, certain companies we saw have made use of corona, meaning they have turned, they've actually switched their threats or their actually their threats into a strength or an opportunity. Right? They have converted it into an opportunity, and through their strengths, they have made use of this current pandemic situation. We saw the value of so many companies going up. The stock market conditions, the general sentiment, investor sentiment, firm-specific risks. Particular firms have their own risk profiles. Market risk premiums, firms' risk premium, risk-free interest rate, what is going on to treasury bill bond rates, the required return by investors, expected cash flows to be generated by the firm. All of these will have an impact on the share price of any company. Right. So that brings us to the conclusion of business valuation. Any questions on that? Any clarifications? Okay. Dinesh, hope everything is clear. Yeah, well, if that's the case, let's move on. Right. So the next area is on capital budgeting. Now, budgeting for capital. Why do you need to budget for capital? What do you all think? Why do you need a budget for capital? What are your thoughts? Do you need to budget your capital, or can you just forget about budgets and spend as you wish? Why is it important to have a budget for capital? Or do you need a budget for capital in the first place? Yes, guys. Only two students in the class, Varuni and Dinesh. What do you all think? Yeah, you need a budget. Why? Why budget for capital? Why do you need a budget for capital? Okay. Forecast about the future, right? But why? Now, is capital limited or unlimited? Now, for example, if you all have a base of 100 million rupees, right? You have 100 million rupees with you, which you are planning to invest. Do you need a capital or do you not need a capital? Do you need a budget or do you not need a budget? If you have 100 million with you, why do you need? Why would you need a budget? To minimize the risk. Yeah, one is to minimize risk. Okay. Yes, you need to plan out the spending and scope of the work which needs to be done, because the main thing is your capital is limited, no? Whether it's 100 million, 10 million, or even 1 billion, the amount of money you have is limited. You don't have unlimited amounts of money, right? Just a limited amount of money which you need to invest properly, use it wisely. So you need to deploy it in the correct place, right? It's because capital is limited. It's a limited resource. That is why you need to make plans about where you're going to invest. If you had unlimited amounts of capital, then you don't have to make any plans. You can go do as you please. Clear? Right, so this is what we are going to cover. Capital budgeting. Right? It analyzes projects that may be profitable, long-term in nature, will require large capital infusions, and it's important for the future of an organization. Okay. So when you're making long-term plans using large amounts of money, you might need capital budgets. Steps in capital budgeting: forecast cash flows, inflows and outflows. You need to forecast your cash flows. What is coming in, what is going out. And so you need a forecast. And assess the risk of cash flows. What are the risk of these cash flows coming? Right? What is the worst case scenario? What is the best case scenario? Estimate weighted average cost of capital, or the WACC. Then you need to discount cash flows. Now, what do you mean by weighted average? What is weighted average? What's meant by weighted average? What do you mean by weighted average? Okay, the capital, Dinesh, which you need to have for day-to-day operations is called your working capital. And that's called working capital. What is weighted average? Shall I explain using an example? Okay. Right, now take for example, let's say you want to buy apples, right? You go to Cargill's. You buy 10 apples at a price of 100 rupees each. 10 apples bought at 100 rupees each. Then you go to Keel's, you buy 5 apples at say 90 rupees each. Tops, you buy 20 apples at 75 each. Maybe you go to Spa, you buy 10 apples at 150 each. Again, just throwing out numbers and prices. If you look at these figures, what is the average price of an apple for you? Can you calculate the average price of an apple? How to calculate the average price of an apple? Yes. So how do you calculate? You need to take the number of apples into the price. You get 1,450, 3,000, sorry, 1,500. And again 1,500. The total spent 4,450. Total mangoes you bought 45. This gives the weighted average cost of an apple. 2,450 divided by 45. $98.89. Okay, so this is weighted average cost. Now, if this was your equity, these were your debentures. You had the long-term loans, short-term loans, showing at rates of 10%, 5%, 20%. Likewise, then the way you calculate your weighted average cost of capital. This is your capital structure. How will I source funds? Right? This gives the weighted. How you calculate weighted average cost of capital is also very similar to the way you calculated the average cost of an apple. So this is billions. get total of 44.5 divided by 415. So your weighted average cost of capital is 10.72%. Okay, so the conceptually it is similar to calculating the price of an apple. Weighted average cost of capital is nothing but calculating the average cost of an apple. Very simple. Something you learned in grade 2. Any questions? Clear? All right. Yeah. Okay, so let's move on. The discounting cash flows, right? This is what we did a couple of weeks back. How you discount cash flows. Remember time value of money, present values, right? Independent and mutually exclusive projects. Independent and mutually exclusive, right? So independent and mutually exclusive means, now independent means now it's like this. If I may use an example, right? If you get married, right? Okay. If you get married, is it legal to have another wife, or is it illegal? If you're married already, is it legal to have another wife, or is it illegal? Two wives at the same time. Legal or illegal? Illegal, right? It's not allowed. That means if you're married, it excludes you having a wife, another wife. You can only have one, right? So that is mutually exclusive. You can't have many, you can have only one. If you have one, that means you can't have anyone else. That's mutually exclusive. But independent, now before you get married, you had many girlfriends. That's illegal or legal? Many girlfriends, at times parallel ones also. Legal or illegal? Before getting married. Legal, right? So having one is okay. You can have as many as you want. Having one doesn't mean you can't have any more. That's called independent. So independent and mutually exclusive. That's how it works, right? Easy to remember. The project is independent if selection of one project has no impact on cash flows of other projects. No impact on cash flows of other projects. Project is mutually exclusive if selection of one project has an impact on cash flows of other projects. Mutually exclusive, if you select one, you can't select anything else. That's mutually exclusive. Right, capital appraisal, the first one is payback period. Very simple concept. Simple concept. Payback simply means how long it takes for you to recover the investment. How long it takes to recover an investment. how long it takes to recover the initial investment using cash flows that occur from a project, right? It does not consider cash flows received after the payback period. Now, for example, let's say you are making, you're building a house. Maybe it costs 10 million, right? 10 million rupee house which you plan to build. Let's say the purpose of building this house is to rent it out. So you're planning to rent it out, and you build a house which is worth 10 million rupees. Annually, let's say you get an income, a rent income of 1 million rupees. So annually you earn 1 million rupees and you're renting it out. How long will it take for you to recover the investment? Your investment of 10 million takes how long to recover? Simple question. If you earn 1 million rupees annually on rent, how long will it take for you to recover the investment? Yeah, it takes you 10 years. Very simple, right? 10 million rupee investment, annual rent income is 1 million. So it takes you 10 million, 10 years to recover the investment. That's the payback period. Your payback period is 10 years. And when you look at payback period, you don't look at cash flows you received after the payback period, right? You only look at cash flows you receive up to payback. Okay, so let's look at this project. It's a 3-year project. You have cash flows of -100. That means there's a minus, in this case means an outflow of cash. Cash outflow of 100 immediately, right? Year 0 means today. First year you're getting 10, second year you're getting 60, third year you're getting 80. So how long does it take for you to recover the cash investment of 100? That is what you need to calculate. Immediately you have an outflow of 100. First year 10, right? Plus, that means you're receiving cash. Second year there is another inflow. Plus 60 means there's an inflow of 60. Third year plus 80 means there's an inflow of 80. So these are your cash flows. Then you do what is called a cumulative cash flow. Cumulative. What is your cumulative cash flow? Now immediately, 100 outflow. First year you are getting 10. That means -100 plus 10, minus 90. At -100 plus 10, you get -90. So still you have a cumulative shortfall of 90. Then the second year, you're getting 60, inflow of 60. So -90 plus 60. You're still -30. So -30 plus 80, you end up with 50 at the end of the third year. Third year, you get 50. That is where you end up. Right. Now it has taken you a little more than 2 years, right? 2 years, between 2 years and 3 years, you end up with 50. Now your payback will be somewhere in between. between the second and the third year. How you calculate the number of days is you assume you receive this 80 evenly throughout the year. Each cash flow comes evenly throughout the year. That's what the assumption you make. So you need to recover 30. You need to recover this 30. And that year you're making 80 over a period of 12 months. It comes to 2 years, 4 months. Now that's 2.375 years. Right. So you can just write 2.375 years. You don't have to go into detail. $2.375 That's how long it takes to pay back. Clear? Well understood? Right. So let's try this second one, project B. Right. This is A. Let's try B. What's the payback period of project B? It requires an immediate investment of 100. First year you get 70. Second year you get 50. And third year you get 20. Then the cumulative cash flows minus 100. immediately. Then at the end of the first year, you have minus 100 plus 70, which is minus 30. Then the second year, you receive 50, so minus 30 plus 50 is plus 20. So you go from negative to positive somewhere between year 1 and 2. Right? Your break even or your payback is somewhere between 1 and 2. How you find it is you're short of 30, you get 50 divided by year, that's 0.6. And so payback is 1.6 years. Right? Okay, now we have two projects, A and B. Is this clear, by the way? Project B has payback period of 1.6 years. What does it mean? What does it mean? It means B takes, if you undertake B, it takes you 1.6 years to recover your investment. Whereas if you had undertaken A, it would have taken you 2 years, 2.375 years to recover the investment. Okay, so that's the meaning of payback. That is how you interpret payback. Clear? Understood? Right. Okay. Now, if you were studying projects A and B, which one will you prefer? You prefer A or will you prefer B? B. Dinesh? B. Why? Because it has a lower payback period, right? A has payback period of 2.375. B pays back in 1.6 years, which means B pays back faster. Yeah, you recover your investment faster when it comes to B. Yeah, so your answer is correct. But there is one question which you should have asked me. You should have asked me one question. What? Yeah, the question you should have asked me is whether these projects are independent or are they mutually exclusive? Are they independent or mutually exclusive? That is the question you should have asked me. If I tell you that these projects are mutually exclusive, then which project will you prefer? If these two projects are mutually exclusive, which one will you prefer? Or which one will you select? If these two projects are mutually exclusive, which project will you select? Right. How do you remember the definition of mutually exclusive? Mutually exclusive means if you select one, you can't select the other. Right. But independent means you can select as many as you want. Right. So these projects are mutually exclusive. Which one will you prefer? Which one will you select? Yes, you're right. You will select B. If they are mutually exclusive, that means you can only select one. And if you select one, it means you cannot select the other. And so if you are mutually exclusive, if these projects are mutually exclusive, you can only select one, you will go for B. Reason is, as you rightly said, it has the lower payback period. Then if they are mutually exclusive, sorry, if they are independent, if these are independent, if they're independent, you can select both. Mutually exclusive, only B. Independent, you can do both because you can recover your investment from both. Right? You will not end up in losses, you will recover your investment. Right? Understood? Okay. So what are the advantages and disadvantages of payback? Pluses and minuses of payback. What do you all think? The pluses and minuses of payback. Very good. Very simple, very easy to calculate. Yeah, simple, so it's easy to calculate. What else? Anything else? Yeah, you can figure out when you can recover the cost. Now, is it easy to understand or difficult to understand? Easy to understand. Meaning any donkey can understand, and also any donkey can explain. Right? Very simple method. What else? Any negatives? It doesn't consider time value of money. Very good. It doesn't look at time value of money. May differ with market conditions, meaning? Yeah, what you mean is you don't look at cash flows beyond payback period. No? Because you don't look at what is happening after the payback period. No? And there is the fourth year. For example, if E gives negative cash flows in the fourth year and A gives a positive 1,000 in the fourth year, you have still forgotten about A. You're only taking B. The cash flows received after the payback period is not considered. Cash flows received after payback is not considered. Yeah. So Dinesh, if you could explain what you mean. Right. Now, one of the drawbacks of payback is it doesn't consider time value of money. Right. So to address that issue, we do what is called discounted payback. That is where you, instead of taking the cash flow in absolute terms, you take discounted cash flows, right? You discount each and every cash flow and then look at it. So let's try this example. Do the workings on your own. Don't look at the answer. says the discount rate is 10%. Discount rate of 10%. Right, so you took the discounting factors, got the discounted cash flows. Now let's take cumulative discounted cash flows. Minus 100 plus 9.091. And you're still negative. Minus 90 plus 49,584. $41,325 negative plus 60.104. You are positive 18.779. Isn't it? Right, so break your payback comes between the second and third year. You're short of 41,325, and that year you get 60.104. So payback is 2.6876 years. Right, so that's project A. Now, to go back a couple of slides. By the way, is this understood? Is this all clear? Yeah, so the only difference is you need to get discounting factors, get the discounted cash flows, right? And then you get the cumulative discounted cash flows. So that is the only difference. Otherwise, it is identical to payback. Hardly any difference. Now, is this clear? Dinesh, you okay? Yeah, which part is not clear? Payback is clear for you, is it? Discounting. Okay, so were you there at the present value calculation? Time value of money? Time value of money, were you there for that session? Dinesh, were you there at the time value of money, sir? Okay. But if you could remember time value of money, present value is equal to future value divided by 1 plus r to the power n, isn't it? So this is the future value into 1 over 1 plus r to the power n, right? So this is the discounting factor, future value into discounting factor. Right? Then, in other words, instead of future value, if I write the cash flow into discounting factor, then you get discounted cash flow. Right. So you get the cash flows here. Then you get the discounting factors, right, which is 1 over 1 plus r to the power n. Right. Then cash flow into discounted factor gives you discounted cash flow. Gives you the discounted cash flow. Gives you the discounted cash flow. Right. So you take the future value, multiply by the discounting factor, you get the present value. Right. So these cash flows are received over a period of 3 years. Here you have an investment of 100. First year you get 10. Second year you get 60. Third year you get 80. This is the first 3 years. Right. These are your cash flows. So there is investment, first year cash flow, second year cash flow, third year cash flow. Right. So remember, these cash flows are not received in the same year. They are received over a period of 3 years, which is why you're getting the present value. Okay, now remember, in payback, you did not look at present value. You only took the future values of cash flows. So that shortfall is addressed in discounted payback, where you take present value of cash flows. And so these are the present values for the discounted cash flows. Understood, Dinesh?
Yes, sir.
Right, okay. Right, so looks like we have run out of time, and we will wind up with this, and let's meet next week. Right, so we'll continue from where we stopped. Okay, guys, so thank you very much. Have a safe week.